Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Pederson. So today I have a Verivest Network member. This is Christina Development, and CEO and the founder of that firm is Larry Taylor. How you doing, Larry?
Fantastic, Lance. Good to be on this program with you.
Yeah, happy to have you. Yeah, so Larry and Christina, they presented years ago. Larry and I were just talking about that at one of our live investor events down in San Diego area. So we've known these guys for quite some time, and they have a pretty, interesting strategy. I mean, Larry's been in the business, as he'll share with you, for a really long time. Been doing this stuff, through multiple cycles. So I think, got a lot of good insight, which we'll pick his brain on today and kind of learn from someone who walks with a limp and's got the scars and lived to tell about it and just continues to be super, super active. And but before we get there, Larry, why don't you share with us how you ended up kind of getting into the real estate biz back in the day? Like what drew you to it? Did you always want to be in real estate, or is this sort of something you stumbled into?
Well, actually, I think all of us humans are genetically inclined to follow a certain path. I think, people who are born with the ability to be artists or writers or poets or whatever, and doctors or whatever, you follow a natural path. I know I followed a natural path because as a child growing up in a small town in Pennsylvania, it was like a coal mining town, I used to walk home from kindergarten, and I would pass a construction site, and I would look through the little cutout windows that they had for pedestrians to view the progress. And every day I would stop by and I would spend 10, 15, 20 minutes watching the progress of the excavation of the foundation to the ultimate framing and so on and so forth. So I was only about 4.5 or 5 years old. So I think I was born with a natural interest in all things real estate, and followed that path continuously from a very young age. Real estate is the only thing that I have ever done, all the way through today. So for me, leaving Pennsylvania, which was a small, really bleak kind of a coal mining town with only 17,000 people, and arriving in Los Angeles to blue skies and palm trees, and just not even be able to understand that I was alive. I thought I might have died and gone to heaven. Yeah. But I do believe that Los Angeles is heaven on earth because of a lot of factors, but I still pursued that which was the early calling. And I started at the age of perhaps 11 or 12 when I moved to Los Angeles, and I moved from a fairly large multi-level home in Uniontown, PA, to Los Angeles, and I saw how people were living here, but my parents could only afford a 2-bedroom, 1-bath apartment for a family of 5. And in Uniontown, where I grew up, that was people that lived in that kind of environment were very, very poor. I couldn't understand how I came to this land of plenty and how I could be living in this apartment. And so I called up a real estate broker and said, got to find me a house at 11 or 12. And that real estate broker said to me, well, why would you buy a house when you can buy an apartment building and live in it? And I said, why would I want to buy an apartment building and live in it when I get out of this apartment building? Are you crazy? So he said, well, no, people build apartment buildings and they build these owner's unit where they're like 3 bedrooms and 3 baths and 4 bedrooms and 10 other apartment units where the tenants will pay you rent. And you can use that rent to pay off your mortgage. And I went, what's a mortgage? And I did learn very early on that you could buy real estate, you could borrow money from a bank, you could use your tenant's rent to pay off your mortgage, and you could live for free. And so that's the first real estate transaction that I recall. And from there, I progressed over time to ultimately selling that and moving into a single family home. Perhaps a year or so later, made a profit. Bought a single family home for my parents. I was 13, sold it and flipped it into another home, which was a bigger and better home, and made a profit. And by that time, I'd gotten a scholarship to go to USC. And when I was at USC, I got my scholarship through the business school with an emphasis in accounting, because I grew up with an influential, legend in the real estate world, a fellow by the name of Kenneth Leventhal, who was the go-to person for real estate accounting. I grew up with his son and his nephew, and I was in the accounting school at USC, and while there, I started to learn more about the multiples of capital that could be made by really owning apartment buildings and how they were valued. So while I was supposed to be there for my scholarship to take all these accounting courses and go into public accounting, I basically took every real estate course that they offered, which were outside the scope of what I was supposed to do to maintain my scholarship. But in so doing, I just became very intrigued with what I could learn in school about real estate. And one of my classes was in a real estate appraisal class. And the final exam was based upon finding an apartment building for sale, analyzing it, and then appraising it. This happened to coincide with the President Nixon's 1972-1973 wage and price level freeze to control inflation. And everything was controlled, from milk to butter to cheese to the price of to wages and rents. I studied in one of my other classes at USC how price controls never work, and when price controls come off, values jump. And so, having evaluated this particular apartment building for my final exam, I reckoned that when the wage and price level freeze came off, rents would substantially go up. And since valuations were based upon a multiple of rents, it quickly showed me how $10 could turn into $100,000. 100 units, increase the rent $10 a month. 10 times 100 is 1,000. Multiply that by 10 is 10,000. Multiply that by 12 for 12 months, and multiply that by 10. How does $10 become 120,000? Just by raising the rent $10 and following the multiples that real estate sells for, and there it was. I was off to form my first real estate venture. So the predecessor to Christina was actually founded when I was a junior at USC.
Wow.
So that's how long, and nothing materially has changed, because the focus has always been on one certain way to make money in real estate is to not lose money in real estate. And the way to not lose money in real estate is to buy real estate at the right price, in the right location, at the right time, and appropriately set your debt and equity in a manner which precludes your being at risk on the downside, and maximizing your return on the upside by buying great real estate in an area where demand will always exceed supply. And that was my I would say my educational process. So while I was at USC, I met another influential person by the name of Sam Freshman, who published the book in 1972 titled Principles of Real Estate Syndication. And the whole concept of real estate syndication was, how do you pool people's capital together and become a sponsor, and then be able to buy real estate and be able to distribute the benefits that come along with it through the syndication process. So all of that gave rise to what became Christina, ultimately founded in September of 1977.
Wow. Yeah, it's so funny because, in the market these days, people act like real estate syndication was invented like in 2016, which is funny, of course, because it's been happening for even before that guy wrote the book, right? Like
a long time ago.
But I mean, it makes sense, right? As we all know that, prior to the Jobs Act being passed, there was sort of a prohibition on advertising and soliciting these types of offerings. So, before the show, we were chatting, right? And as you brought up, is that it was always a who do you know business, right? So if you didn't know real estate developers like yourself, then you may never know or have opportunities to invest in a real estate syndication or a fund or some opportunity. So that the doors really opened on that, and with this last bull run. Multifamily in particular, people understand multifamily and have, realized now that, wow, if I'm an accredited investor, I can invest in these things and get, the same benefits that the gentleman who wrote the book was talking about back in, the 70s, right? But for you, Larry, I'm curious, you've basically for your entire adult life have been in Los Angeles. And I know you are by way of like supporters of Los Angeles go in the real estate market, that's your thing. Whereas I hear many other, Angelinos, who all they can talk about is how it's impossible to transact in Los Angeles, and they might live in Los Angeles because, as you said, it's a heaven on earth sort of place. But they're doing deals in Colorado and Tennessee and Florida and everywhere but Los Angeles. So I'm curious, how do you, and you've been doing this a long time, and you've seen many of these cycles and these sort of things, like how do you continue to have the ability to transact in Los Angeles? Like what's the trick? What do you know that maybe some of these other guys don't know about how you can make it work?
Well, again, for those who don't understand Los Angeles is a huge, broad, spread out city. And the Westside region of Los Angeles, which is where we've been focused for nearly 50 years, consists of 5 separate cities all tied together by streets and freeways. And so within the Westside region of Los Angeles, you have the city of Santa Monica, the city of Beverly Hills, the city of West Hollywood, the city of Malibu, unincorporated Marina del Rey. And a lot of people don't understand that Playa del Rey, which is on the beach near the airport, is also in the city of Los Angeles, as is Elysian Park or Echo Park or downtown. And Los Angeles is one of the rare cities in the world that has no reliance on a central city core to feed its growth and to feed its economy. So you have all of these separate cities within the general area of the west side of Los Angeles. So, while it might seem very defined and finite, it is absolutely a huge swath of geography. And so the changes that have occurred in the last 50 years are demand has never ceased. People moving into the west side of Los Angeles has never stopped. And the change in 50 years is there's now no available vacant land. So we have constant demand, limited supply, the best year-round climate in the United States, if not the world, and more businesses, in this marketplace, more diverse industries that continue to feed growth, probably more than any city in the United States, if not the world. We're the hub of technology. We're the hub of entertainment. We're the hub of trade with Asia. Our ports are the busiest ports in the United States, if not the world. And on top of that, we've got aerospace, which was started during World War II, expanded through the 60s and 70s, kind of had a decline in the 80s and 90s, and then in the 2000s and 2010, 2020 now we have SpaceX and maybe 25, 30 different aerospace companies. all on the west side of Los Angeles, having nothing to do with downtown and the San Fernando Valley. There's a whole nother part of Los Angeles on the other side of the Santa Monica Mountains, which if it was incorporated, just that part of Los Angeles was incorporated as a city, be the 8th largest city in the United States. So you have this vast region, but the demand in the West Side region has never been other than on the uptick. The concentration of wealth is greater than any other location in the United States, except perhaps within the core of Manhattan or maybe in a few other locations. But generally speaking, you can take like Silicon Valley and all the billionaires in technology, but in technology, Silicon Valley, which is now Silicon Beach, because the weather is better here, the quality of life is better here, and the cost of living is less because there's greater choice in a broader geographical area than trying to squeeze into a small older city like San Francisco. So, the greatest fortunes in real estate have been made by those investors and sponsors who have focused on a defined geographical area. And that's the whole story in a nutshell, which is we're very, very focused. And if we owned $100 billion worth of real estate in the West Side region of Los Angeles, it would not make the headlines. That's how much real estate there is just in the West Side region alone.
Yeah, no, it's a great, and I agree with you. This is what I talk to guys, real estate sponsors, emerging and long time, and guys who've been in the business a long time, and that does seem to be the commonality. Once again, getting into the real estate business is the long game. You don't get rich quick. It doesn't happen overnight. And if you think it does, then that's what you're looking for. You're in the wrong business. As you said, you can create value if you know what you're doing. But the commonality between those who have long, sustained success is that they focus on an area, right? Like they draw their own version of boundaries of like, this is where we're going to transact. Because fundamentally, one of the benefits of real estate, as you're basically pointing out, is that fragmentation is a feature. It's everywhere, right? Like there's lots of it, and no one can control it all, to your point. Even if you owned $1 billion of real estate, they would even no one would notice, no one would know. You wouldn't even be a big landholder or whatever the case may be. So, so when you're a passive investor and you're looking at someone who's going to, put a deal in front of you, investment opportunity in front of you, it's one of the first things you have to look at, right? Is like, what's your strategy? Where do you transact? What's your philosophy? And if it's sort of like, well, we're going to do deals like in these 50 different markets, it just seems, or whatever. Even if it's like, we're going to do some stuff in Jersey and some stuff in Florida, or I don't know, wherever opportunity finds us, those are the things to kind of stay away from. And I think that's why I like what you guys do, is that even though there's people who are like, we don't get the stomach to transact in, Los Angeles Metro or Southern California in general, and they, invest elsewhere, it's the ones who just say, we're planted here, West Side. Like you said, you've got it nailed down as to this is where we're going to do business. And so for you, when you're doing that, though, it comes to my mind that given the nature of that market, when you transact, because many of these other syndicators or fund managers, they buy the stuff and they can't wait to sell it. Now, my hunch is that for someone like you, you're more interested in transacting, not necessarily as interested in selling. Because once you get a hold of this real estate, why would you ever want to get rid of it? Is that accurate?
Well, that's the key point. If you're lucky enough to own great real estate, as a number of people and a number of families and entities are, great real estate rarely ever becomes available. And so, we're always looking for those opportunities where there's a death, a divorce, a bankruptcy, a partnership dispute, or a fund reaching its maturity and it has to liquidate. But there are very limited opportunities to buy great real estate. And when it becomes available, if you have that access to it, you act upon it. And, for 45 years or more, Our strategy has always been to buy great real estate at least a 20% discount to then value at the time of purchase, and to own it for an extended period of time until somebody decides they want to buy it from you. Because when you talk about liquidity and illiquidity, and real estate being an illiquid asset, the most liquid real estate you can possibly own is great real estate, because even in a down market, there will be a buyer. It's just a question of price. So we rarely, if ever, offer any real estate for sale. People just offer to buy. And if we get an offer sometimes that's extraordinary, we'll sell. But there's very, very few opportunities ever to buy great real estate in a market like this. But our returns over the last 4 decades have probably been on average of over 20% per year, not taking into account tax benefits. And our multiple of invested capital has been over 2, generally, sometimes as high as 6 or 8. But, again, it's like owning the real estate is where the real value comes in, not selling the real estate, but owning it. And when you talk about, instantaneous gratification, that gratification happens the first day you own it, because the government rewards you for owning real estate. With all the stimulus that's available, there's only 2 industries in the United States that are primed by the government: real estate and oil and gas. So, in the life of real estate investment, the depreciation, amortization, bonuses, tax credits, and everything else that you get offsets your income for a number of years. So, we take full advantage of that, as all real estate investors do, but most aren't informed because, as you mentioned earlier, prior to 2012, 2013, we didn't have a Reg D 506C of the Securities and Exchange Commission Act, which allows us to market exempt offerings in 50 states. And we don't syndicate anymore. We haven't been a syndicator in many, many years. We syndicated from 1975 to 1991, and then we had a capital partner from 1991 to 2006, multiple capital partners. DLJ, Payne Weber, UBS, Warburg Pincus, and they were our partner and provided the capital. And then since 2012, 13, right after 506C and the Jobs Act, we formed private equity real estate companies. They're not funds. They're the same structure as a syndication, 30-year life. And these companies raise their capital from their members, and we buy maybe 6 to 8 or 10 properties within one entity. And then we use the losses generated by the depreciation and amortization to offset any income or gain when we exit. So pretty much none of our private equity companies yet have had to pay tax.
Yeah,
now that's the holy grail.
Yeah, that's right. That's the Donald Trump stuff there. Everyone was up in arms, like, how is he not paying any tax? Right? Well, it's like the government gave you that's the beauty. Like, it's written in law. You can use it, right? They allow you to take those, depreciate those assets, and it's all right there if you take advantage of it. And it's great because it's pretty, obviously you're getting the benefit, you're getting cash flow from the real estate assets, right? And then, any appreciation that's occurring, and you're not having to pay taxes on it.
Well, so again, you're right. The reward happens the day you buy, but if you buy right, and you buy below market, and you buy great real estate, the reward starts on the day that you acquire the real estate. On the other hand, there's no such thing as a risk-free investment, and of course, real estate is a cyclical business. It definitely goes up and it definitely goes down. And so it's almost like surfing. I happen to live on the beach, so I always, think about the waves that come in. Every wave is different, and every now and then you get a rogue wave, and a rogue wave can be very devastating. And, we like to be extraordinarily aggressive buyers when the market is down, and we're extraordinarily aggressive to sell our real estate when the market is overbid. So it's just knowing knowing when to hold them and knowing when to fold them, but understanding that there's risk associated in every aspect of real estate. And managing those risks takes a qualified sponsor. But the concept of being able to own multiple properties within one structure and allowing them to play off one another and taking that opportunity to accredited investors in 50 states, which was never possible before, the law changed, that's the holy grail. Because most people grow up with the understanding embedded in their brains by their parents or their grandparents that owning real estate is a tangible thing. I want to own something. And there are very few investment opportunities out there for people to own essentially real estate. And that's the opportunity that we've always brought, but it's always been exclusively for the wealthy. Exclusively for the wealthy. And so today, you still have to meet the accredited investor requirement, which is not everybody. There's probably 10.5 to 12 million accredited investors in the United States, and there's probably 90% of them that have never had an opportunity to invest in great real estate and own a piece of something that's worth something instead of a synthetic thing like a stock or a bond or an ETF, which can be worth something one day and worth zero the next day. That's real estate.
That's right. Yeah. So for you, like, what does your process look like for, keeping up to speed with the opportunities in the market? Like, I'm assuming there's some method to your madness. I mean, you know where you're going to transact if you're going to, but is it a lot of just like broker relationships, and how do you make sure that you're in the deal flow, right? Like, how do you make sure that if an asset's going to hit the market one way or another, that you're going to know about it and have an opportunity to, what does that look like for you guys? Especially, like you said, I mean, it's Westside of Los Angeles is gigantic. It'd be the 8th largest city in the U.S. if it stood on its own. So how do you make sure that you keep up to speed on, the opportunities that are out there?
Well, I think it has most to do with our longevity in the West Side of Los Angeles, in this region, and our relationships, our history of continuous profitability and no losses, and the fact that we have a history of performance. So we have lawyers, estate lawyers, we have bankruptcy trustees, we have accountants, real estate brokers, title reps, whereas where these opportunities start to present themselves. So if there's death and the estate has to be valued, we'll get a call from an appraiser who says, oh, by the way, the Smith estate is coming up and we're evaluating their 18 properties in Beverly Hills and Century City and Brentwood. And just thought we'd tip you off that they're going to be selling these assets. So we'll get a call from an appraiser long before the family's ever gotten to that point of having to decide which assets to dispose. Like last year, we bought an entire portfolio of properties, multifamily properties, in one of the most dynamic areas in the West Side from a family that the patriarch who built the properties in the 50s and the 60s passed away in 95. So we got the call from the trustee who had to figure out a way to sell at least a portion of the portfolio to pay taxes. And estate taxes have to be paid 9 months after the death. And anybody who dies and owns a huge portfolio of real estate generally doesn't have the liquidity to pay the tax, so they're going to sell something. And that's just, just one of the ways. And oftentimes, too, is that when there's consideration of a sale for other reasons, there'll be a property owner that's looking to get a valuation. So they'll go out to a number of different brokers for an opinion of value. And we might get that call very early on saying, so-and-so's asked us to look at this. We thought you would be interested in it. And we'll take a look at it and say, look, we'll just buy it. I mean, I was just on the phone with the president of CBRE with regard to what I would call a landmark property in the West Side that is well known throughout the world, which we were looking at acquiring. And he was asking if I was going to make a bid, and I went, no. And he said, why? And I said, because too many people know about it, and we don't get involved in competitive bidding. we'll just wait it out, see what happens.
Yeah.
And what sometimes happens is the high bidder ties up the property, and 3 days before the close, they can't come up with the money. And then we get the call saying, hey, if you want it, this is falling out, we're going to keep his deposit and we'll sell it to you for X. So, it's just knowing the market and making sure that the people who are active in the market know that if we say we're going to buy something and we go under contract, we're going to close. And certainty of performance is what guarantees that you'll get the deal.
Yeah. And then for you, I mean, it sounds like you're pretty agnostic about it whether it's, development, redevelopment. I mean, maybe even buying something where you're going to go like raise it and go ground up, or do you stay away from that kind of stuff, like full on construction development, or what does most of your projects look like? Are you just opportunistic, like you said? It's when you have the opportunity to buy well-located, good real estate, you're going to contemplate it, or do you have, more boundaries?
Well, we're product agnostic and we're geographic specific. So we'll buy any real estate investment grade within the 7 submarkets of the Westside region of Los Angeles. So as far as, risk return analysis, right? There are very few development opportunities in the Westside region of Los Angeles because there's no vacant land.
Yeah.
Also, development dictates betting on the future. So you're not the value bought at that point. Now you're looking to create value by building something. That's a risk that might not be worth the return because of the unpredictable nature of development, because when you create the concept for a development and by the time you realize it, the world changes. If you created a project in 2018 and it came on market in April of 2020, you were screwed, because how could you predict a 100-year pandemic? So our philosophy is very simple. We're not looking at deals. We're building curated portfolios in private equity companies, and we're using an aspect of funds which allows investors to commit a certain amount of money that's callable over a 2-year period of time. And then we take that money and we buy great real estate and we fill that portfolio up. So let's say we raise $100 million in equity. We might buy about $220 to $250 million of assets, and we'll put them all into that portfolio. And we'll try to curate it as a balanced portfolio so that it'll have properties with different aspects. But the key to avoiding failure, which is the first step towards being successful, okay, is to be able to understand how these properties play off of one another, and each property should have a multiple exit strategy. So we might buy an apartment building and convert it to an office building. Or today we might buy a multi-tenant office building and convert it to a single-tenant building. Or we might buy an apartment building and tear it down and build a shopping center. So, just depending on what the opportunities are, but if you buy like you buy an industrial building in an industrial area that can only be used as an industrial property, you really are screwed if the industrial market goes to shit. And so we're never in a situation with any property that we don't have multiple ways of extracting value over an extended period of time.
Yeah, so that's interesting. Yeah, so you do look at it as you're curating a portfolio. It's not just, asset by asset, like find something we like, buy it. You have to look at it like, because right now you guys are on Christina 4, so you're curating the Christina 4 portfolio. And so when you guys are looking at opportunities, you're trying to make sure you don't overweight yourself. I mean, it sounds like in general, like you said, the industrial analogy, like it's only a single use, really have to think hard about, especially if there was already some industrial exposure or whatever, you're trying to make sure that this thing can hold up no matter what, even if one of the assets maybe has a bit harder time, the other assets might be it's almost a bit like hedging. It's like you're trying to make sure that the collective of the assets can kind of get that outcome, which I'm not sure if a lot of people just choose, it's a self-storage fund or whatever, and that's their criteria. Shove self-storage deals into fund. Whereas you guys, you don't
Well,
get
look, this is a huge industry, and there's so many people that have great strategies and have had great success with their strategies. But the concept of owning multiple properties under one umbrella allows an investor to utilize the passive losses against passive income. Because if you don't own real estate outside of an investment, if you only own one property, and you have all these passive losses, you have no use for them. They're suspended until that property is sold. And so when you own multiple properties within the entity, you're able to use those properties' losses to offset gains, which is what we do in Christina 1, 2, and 3, and now in 4. And so this is just a growing strategy and structure, which we believe ultimately will be the dominant structure of how real estate is owned in the United States. I mean, it's a big deal, but in terms of, well, one property might be able to do better than another. Yes, if you have 10 children, all the children are going to do something different, but each property has to have a multiple exit strategy within that property. If it doesn't, we don't own it. So in Christina 4, for example, in the one portfolio that we bought, which is literally across the street from Television City and the Grove, two of the most prominent tourist locations and entertainment and retail destinations in Los Angeles, we bought 4 multifamily properties that are worth a lot more money as multifamily, but they're worth even more redeveloped into fee-ownered condominiums. So we're entitling all of those to be demolished and sold as condominiums. But once we're entitled, we just might sell that property entitled to a developer, depending on the metrics. So, again, even on our property that we just purchased last year on the beach in Playa del Rey, we bought one of the only property built on the sand in Playa del Rey, adjacent to one of the deepest, sandiest beaches, and one of the only pieces of the city of Los Angeles that touches the beach, which could never be rebuilt because the building was built in 1968, and in 1972, the Coastal Act passed, which precluded it. So the value of the building can only go up. So maybe we'll convert that building to condominiums and sell them for $2 million a unit. We bought it for $600,000 a unit, but as an apartment, it's worth about $900,000 to $1 million a unit. We bought it from the original developer. So think about it. Built in 1968, bought in 2021. The seller's 95 years old, who determined that it was better to sell while he was still alive and distribute it to his children and grandchildren than it would be to wait till his death. If the estate tax changes, they have to pay more estate. His beneficiaries will get less. The thing was never going to be sold.
Yep.
So that's every single property that we have purchased in memory has a story, because otherwise you couldn't get that property. Yeah. And for us, that's the holy grail. That's why we make the kinds of returns that we do. And that's the structure allows us to shelter those returns. So our members who participate in our limited liability companies don't pay tax. Or if they do pay tax, it's de minimis based upon accumulated passive losses. So, for example, investors who have participated in Christina 1, 2, 3, 4, even if we start showing gain on Christina 1 because we've sold 3 properties to date and we've returned nearly all of the equity and still own 4, right? We are now at a point where our gains exceed our losses, so the next sale, when there is one, would be taxable. But those investors, many of them are in the other real estate companies. They just continue to fund, and those losses are offsetting those gains. They still pay no tax.
So how do you do that how can they do that if they're not real estate professionals? How do they use an investment from, across portfolios? Is this a bit of a different structure as you have it, or it just?
No, that's the tax law.
Yeah.
Passive income and all passive loss nets each other out. But remember, passive losses
can't offset the
used
ordinary.
against investment income. It doesn't even offset dividend income. So what happens is people who buy one building or invest in one deal or two deals, they don't have enough to utilize the benefits that government gives us. So, I mean, as long as you're generating losses from your portfolio based upon bonus depreciation, accelerated depreciation, componentized analysis and componentized depreciation, so long as you continue to invest, but at least in the initial years, in the 30-year life, in the initial years you generate so much loss, you can exit some of your assets at very high prices and pay no tax. So our strategy is de-risk the investment, buy below value, manage effectively, grow value, look for exits, generate tax losses, and pay no tax. And that's much more attractive than, earning, taxable income on anything. And it's more attractive than owning bonds because you don't have the upside in owning bonds.
Yeah, no, and they've proven to be, they're far more volatile than, it's just, even the bond markets are, it's crazy. So it's that volatility that you have. It's just, I think the big issue, right, is that most people, it's one of education. I think that people, when they thought of real estate, or when they think of real estate, think of just buying some rental house or something, or maybe a REIT, right? But REITs often have, if they're publicly traded, then there's volatility there, right? Because the market's deciding what they think that the share of that given REIT should go for. And once again, not to say that all those things are bad, but it's just understanding some of the things like you're talking about with, obviously the depreciation and how it offsets your, the income and the passive losses and, all those sorts of things. Like this is why people, when they get into real estate, you make a lot of money, right? Not to mention, some people who invest in these things with their self-directed IRAs, and, there's so many things you can do now that you have access to these things. And especially when you can go into a portfolio of assets like you guys have constructed, right? It's a lot easier. You make one allocation in instead of, hunting for, all these different syndications and, that come and go. And then even the Los Angeles stuff too is always the thing. It's just, I don't see many other, it just doesn't seem like there's a lot of, and maybe I'm just not seeing it, but there's not a lot of operators out there who even have stuff, investment opportunities, whether they're syndicated or funds that are available in the market. Have you noticed that?
Look, it's an exciting time because you're taking an industry that's been established for, hundreds of years. But in 1933 and 1934, with the Securities and Exchange Commission, it nearly made, real estate investment unreachable to most people, because unlike stocks or bonds or other types of investments that people can make, real estate takes active management. You can't just buy a piece of property or invest in some real estate and not have to deal with the management. And under the regulatory environment that we have today with Cal Green and Title 24 and ADA, and there are just so many restrictions, rent control, the governmental compliance requirements that go along with owning real estate are so great that you have to have a sponsor. And if you have a sponsor and you have an opportunity and you don't know that it exists, because prior to 2013, we were never allowed to reach investors in 50 states, the world has changed. And so we finally have an opportunity for people to be able to have a tangible asset. For example, just by way of example, we capitalize an entity with $100 million in equity, and an investor invests or commits to invest $10 million. That's 10%. And that entity buys 10 buildings. Well, that investor who put in 10 million owns 10% of 10 buildings. There's no fluff, there's no, corporate jets, there's no 400 employees trying to figure out how to live off of the income coming from real estate, because in a REIT, where does the revenue come from? Rents. So how much of the revenue goes to pay that management structure? So, and then if it's publicly traded as a security, what do you own if you own a trust certificate in a publicly traded REIT? Nothing more than a synthetic piece of paper. But if you own 10% of an entity that owns 10 buildings, you own 10% of those buildings, and you can actually feel like you own something that feels good enough that gives you the comfort of owning something versus owning nothing. And that's kind of the challenge that we have in our industry, is to be able to communicate out, all of the benefits that come from owning real estate, but not to not to look at it and understand that all investment is risky. There's no such thing. But what befuddles me more than anything else, I'll share with you, Lance, is that the best investment that you can make with the least amount of risk, right, is to buy a 10-year treasury at 1.56%.
That's right. That's the
You know that if you give the government your money, take that $10 million and buy a 10-year treasury at 1.56%, not only will you get your 1.56%, but you'll get your 10 million back at the end of 10 years. You don't have to do anything. But anything outside of a government treasury, a government issued bond, the greatest safety investment that you can make is risk. So when somebody says, I want to make 10%, and I go, well, that's 7.4 times more than the risk that you would take by buying a 10-year treasury. I go, you're taking a lot of risk if you're expecting 10%. But investors who reduce their expectation, understand that they can grow their wealth and preserve it and grow it in an extraordinary exponential way, because remember, you can finance and refinance a real property investment for its lifetime and distribute that money and never pay tax. So the idea is to buy a building for 10 million, put down 4 million, borrow 6 million, operate it properly, grow the value to 15 million, borrow 10 million, give back the 4 million. Now you have no money invested in the property. It keeps generating cash and losses. And then 5 years later, you borrow another 5 or 10 million on it. You distribute that tax free. The building has gone up in value. You've now gotten 2.5 times your money, and you still own the real estate. By now, your gain would be huge, so you have no reason to sell it. So you just keep it, and then you pass it on to your beneficiaries with a stepped-up basis. So how wealth is made, that's our business. Our business is to take advantage of making money the old-fashioned way, is owning something that has the potential to be able to give you more than almost any other investment can give you. And that's what we do. And we've done it successfully, and we're thrilled to have this structure and strategy in place where we can communicate it, because it's really hard to sell people things that they don't want.
Yes.
Right? That's what marketing is all about. We're going to tell you that you need something, even though you don't think you need it or you don't want it. But what we do is we've got 10 million people out there who are capable and want it, and we're over here and we have it. And today, through the change in law and through technology, we're able to bring it together. For example, we have 500 visitors today to our website. 500 visitors. We have very little opportunity left in our Christina 4. 500 visitors today. We sent out 50 subscription documents. We will close this out in a matter of weeks.
Yep.
And how did they find out about us? There was a massive article that was written in a Los Angeles Business Journal. It was picked up by about 20 other newspapers around the country. Million Acres wrote an article on us. I mean, it's just out there. And that just shows you that we're not trying to sell you on anything. We're just saying, here it is. Yep. Here's what we have. If you want in, send check. And that's right. And that's kind of a much more, and it's always been that way for Christina. It's always been that way. Great real estate, people that have wealth, they want to be able to own that real estate and get the benefits that the government gives you. And more benefits are coming this way. And with tax rates going up, which is likely if you've read the latest Biden proposals.
Yeah, as of today.
But in order to stimulate investment in infrastructure, which is real estate, we're going to start seeing a whole new slew of government bonds and tax credits for certain types of opportunities. So it's a very exciting time, but it's always changing. It is cyclical, and that when the cycle goes against you and you're an investor and you want to get out of that deal because you can't, you see yourself going bust, but you can't. It's not like a stock where you can just get out.
Right.
You got to hold on. And if you have a great sponsor and you own great real estate, one thing that I have proven as the founder and president of this company is no matter where the cycle is, if you just stay in it and you manage yourself through it, you're only going to make money. There's not more money. There's not one property that we've sold hundreds of properties. There's not one property that we've sold that we could buy back today for what we sold it for.
That's right.
Now, you're not going to see that in Tuskegee, Wisconsin, or Butte, Montana, or any of these tertiary markets where the rents don't change in 30 years.
Yeah. No,
but we talked about multifamily early in this podcast, and we were buying apartment buildings in Santa Monica in 1978 and 9 for $35,000 a unit. Today, those are $650,000. We sold them for $100. We thought we were the smartest people on the planet. If we had just never sold them, right? We bought a building a couple of years ago from an estate where the woman died at age 100. Her father built it in 1921. Okay, so the building was in the same family for 100 years. It cost him $14,120 in 1921 to build this building on nearly an acre of land, a massive commercial building. We paid $23.5 million for it. 14,000 to 23.5 million, and that doesn't take into account the tens of millions of dollars that this particular woman that lived to age 100 earned over the life of the asset. It was paying her out $1.2 million a year in the last 20 years alone.
Yeah, that's right. That's right. And that's real estate. That's what I mean. It is exciting time because more and more and more people are now aware of it. And then they're learning and they understand it. And, I know for us, that's just like it is for you, Larry. I mean, this is what gets me up in the morning. I just feel like I want more people to know that this exists. I want them to feel more comfortable, like get them introduced to it, understand that I know it sounds crazy, if you can earn 10, 12% returns, and once again, there's risk there. You understand the risks, but then you can get into it and make some kind of allocation. Your portfolio should have exposure to this to some degree, and it's just exciting to see how much of that education is happening. People are realizing this market's only going to get bigger. Like you said, we've got a cap on how many people are accredited, but still, like you said, 10, 12 million people in the U.S., households, that's still a lot. And when you look at the number of people that have invested in like a private placement real estate deal, it's nowhere near 10, 12 million people.
Oh, it's de minimis.
It's nothing. So it's good stuff. I know we're running along here, but where can people learn more about you? You mentioned the website. Go ahead and tell them how to find the website.
Well, we're ChristinaLA.com.
Yep.
Very simple. And it's I will tell you that it is not the most up-to-date, latest, greatest, fanciest website. We're a long-established firm, and we're trying to build into that to make it more accessible. But the website is pretty informative. And also, you can reach us at info@ChristinaLA.com. Directly in touch. That'll put anybody directly in touch. But I want to commend you too, Lance, since I met you years ago at the very earliest stage of life after the Jobs Act and 506C. And, I commend you for doing, what you've been doing to be able to broaden the opportunities to the public. And I would close my long commentary, and I apologize for running over, but, at the end of the day, we've never had wealthy, all of our investors had to be wealthy because of the accreditation and securities laws, but we've never had an investor coming in saying, I want to earn 10%, I want to earn 12%, I want to know my hours. No, investors just want to own great real estate. And if you own great real estate and you do it right and you have a good sponsor, you'll figure out a way not only to grow your wealth, you'll do it in a tax efficient way. The idea is to grow it and not pay tax.
Yep.
That's
Yep,
the key.
that's right.
That's the key, because otherwise there would be no incentive to own real estate, which is illiquid, and a hard asset, which is management intensive. The government rewards you. And that's what people have to keep in mind. Most people don't even understand it, which is why they didn't understand Donald Trump's tax returns. And they never saw Donald Trump's tax returns, because if they saw the gross amount of revenue and the de minimis amount of tax, they would not comprehend the benefits that come with real estate ownership. But they are balanced by the risk that real estate is, because you can't necessarily take your equity that you've built up in a property and then go to the market and buy a bag of groceries with it.
That's right.
But you could sell a stock like that and get the money in your account, and then you could go do what you want with it.
That's right. Yep, that's right. Yeah, it's a beautiful thing. So thank you so much for taking the time. It was great having you on. I'm glad we were able to make it happen. And ChristinaLA.com, if you want to learn more about Larry and his team. Thanks so much, Larry.
Thank you, Lance. Have a great day, and appreciate the opportunity to chat with you.
You're welcome, sir.
Take care.
Bye now.
Bye.